Hi, for today's lecture, we're going to talk about the issue of picking the tested party when doing a transfer pricing analysis. So every transfer price is a transaction between two parties, often a parent and a subsidiary, or it could be between two subsidiaries. And essentially, it's important to pick one of these two parties whenever you're going to be conducting your test based upon, say, profitability, to pick the one whose profits you're going to be testing. You can actually test both, but in many cases it's going to be very hard to find a good reference point or, say, comparable to test at least one side of the transaction. So there's a fair bit of effort that's put into deciding which of the two parties to the transaction should be the tested party. That is the one that you're going to test. So I think this works best if I do this by an example. And in this case, we're going to have a fictional example, but we're going to use the firm Nike. This is not to say I know Nike's supply chain or how it operates, but simply it's an easy one to talk about because everybody recognizes Nike, the company name, the product that it makes, etc. So in this very simple example, let's start from saying that Nike, a U.S. company, sets up Nike Canadian Distributor. So it's a subsidiary of the Nike parent corporation set up in Canada, and their whole job is going to be basically that they're going to buy shoes. Nike is going to sell shoes to the Canadian distributor, and then the Canadian distributor is going to turn around and ship those shoes out to customers. I use the term ship out the shoes and sell them essentially because Nike Canadian distributor is going to be a wholesale distributor, and it's in most cases going to be selling to other stores that are going to go out and sell the shoes. I know Nike also has some retail stores of its own. Let's keep the example simpler and imagine that Nike sells the shoes and they go out to Olympia Sports and all the other type sporting goods stores out there that might sell their shoes on to customers. So that's our basic transaction here. The transaction from Nike to Nike Canadian Distributor, that's a related party transaction. That's where the transfer price becomes important. Now, Nike owns all the technical design and all the marketing intangibles, the swoosh that's on the side of every Nike product. So those are Nike's contributions that are very important to this whole activity here when we think about it. So given that's what Nike owns, then we move along to say that the Nike Canadian Distributor is a wholesaler. It's going to sell to numerous other retail distributors, right? Situation. In this particular case, the Nike Canadian Distributor is basically, in many ways, facing a perfectly competitive market. If Nike decided not to open up its own distributor, it could probably go out and hire any number of Canadian wholesale distributors and say, here, I want to sell the Nike shoes to you, and then have you go out and sell them to all those retail shops everywhere else around. It could find a way to work without having its own distributor up there. The functions of being a distributor, a wholesale distributor especially, there are no particular barriers to entry. It's a pretty competitive market. You could enter into this market with a relatively small investment up front. So the Nike Canadian Distributor is going to be essentially economically acting like a firm in perfect competition. And we've had a couple of lectures in the last series of lectures that went and talked about how when a firm is in perfect competition, it will earn no economic profits. It'll have a sort of normal accounting profit, which is fine. Because, we're going to use that as our reference point for figuring out how to set the prices. And then what we would do is we'd start searching for comparable firms. So when we start to do this, we have to say, are we going to try to search for a comparable firm to Nike? Well, if we have to do that, we have to find a firm that's got an equivalent brand recognition. That's pretty tough in and of itself. We've got to find a firm that has the same technical patents or patents that give it, sort of a real advantage in the market. Remember, brand recognition, technical patents, these are things that act as barriers to entry. Think of also all of the sort of other marketing intangibles that Nike owns, such as the endorsements. So it gets some very, very important athletes to endorse their products, and that can be very helpful in marketing the products. So essentially, those are all things that are owned by Nike. Now, could we go out and find another firm, or hopefully even a whole selection of firms, that have something really equivalent to this that we say that's exactly like Nike? So whatever profit they're earning, that's the kind of profit Nike should be earning. I'd really posit to say that's going to be hard. Nike is going to earn an economic profit. It has got the exclusiveness on the Nike products, the brand, the technology that goes into them, etc. And as such, it's going to be earning a real premium for this. It's going to be hard to find another firm that's quite like them. On the other hand, trying to find something comparable to the Nike Canadian distributor, well, that's not so hard, right? We could look for any other wholesale distributor that's distributing shoes or sports clothing or clothing in general, or even consumer non-durable goods. And we'd probably come in and say, well, they're doing the functions that a distributor does. They take the same risks that a distributor has. The amount of profit, they're all in a perfectly competitive, probably, situation if there are a lot of them out there. So we can pretty much say this is the kind of normal profit that a distributor would earn. It's going to be much more straightforward to find firms, especially when the market's very competitive, and none of them are going to be earning probably an economic profit. They're going to be making an accounting profit, without a doubt, in most normal years, but it would be unlikely that they're going to earn, say, any big economic profit sort of thing. So, in summary, it's going to be quite hard to find a bunch of firms that we would arguably say are comparable to Nike, but probably very possible that we're going to find a lot of firms that are comparable to Nike's Canadian distributor. So let's keep going with our fictional example. We've got Nike at the top of this chain, right? Now, Nike, as we've said, owns the technology, designs, the patents, the marketing tangibles, the swoosh, everything. Now, where do the shoes actually get made? Well, in all likelihood, Nike has got a manufacturer, let's assume it's in China, and the Nike Chinese manufacturer is like thousands of other Chinese factories out there making product that are selling them on to Nike. So the product is going to move from Nike Chinese manufacturer to Nike. Now, you might notice here I put in here product and I put in the word title, that the Chinese manufacturer will sell the product and it'll come, when they sell it, they'll recognize it as revenues. Nike will buy it. They're going to recognize it as a cost of goods sold, or essentially a cost going into their inventory, at least initially. Okay? And then what we really want to focus on here is that the Nike Chinese manufacturer, as I mentioned before, it's like 1,000 other factories in China operating. It's operating in a very competitive market. In fact, Nike could potentially not bother organizing to have its own manufacturer in China. It could probably find any number of firms in China who would be willing to manufacture the shoes exactly to Nike's specifications. Nike will own all those technology and patents, etc., but the shoes will be made by a manufacturer in China. In our example, it's Nike Chinese manufacturer. It's a subsidiary. Because it's a subsidiary and it's selling back up to the parent, we've got an intercompany transaction. And that's where we're going to have to set a transfer price here. But let's face the concept here of going back to how are we going to pick which of these two firms we're going to examine for determining the profitability. Well, we already ran through with the whole concept of trying to find a comparable to Nike and said that would be quite hard. But trying to find a comparable to the Nike Chinese manufacturer, that's an easier proposition. We could look for people who are manufacturing shoes or manufacturing clothing in general or other consumer goods. Probably you can find someone out there who is also operating in a perfectly competitive environment, and it's not going to earn an economic profit. It is going to earn a normal profit for taking risks and operating and getting a return for the investment that it makes. Economists would say, all right, that's the opportunity cost. We treat that as a cost. Accountants would say, yeah, no, that's not how we do the accounting. So they're going to have a real operating profit as a result of being in this business. But it should be very possible to find some good comparables that we could use as a reference point for how much profit the Chinese manufacturer, the Nike Chinese manufacturer, would earn. So with that said, let's bring our whole example together, because this is actually going to look more realistic in a world of transfer pricing. Because what we have going on here is the manufacturer is going to make the product. They're going to sell those shoes to Nike. And Nike's going to take title to the shoes, and then Nike is going to sell the shoes on to the Nike Canadian distributor. Okay, Nike has lots of other transactions. It's going to hold on to some of them and sell them in the U.S., and it's going to sell some of them maybe to all sorts of different places around the world. But let's just stick with this simple example that Nike is going to have the shoes manufactured in China, and then it's going to turn around and sell them to the Canadian distributor. We have two related party transactions going on here. Now notice here I've got the product title moving because, quite frankly, in all likelihood, China will just ship the shoes directly to Canada. Right? There's no reason to ship them into the U.S. and then have them show up and ship it again into Canada. Just be inefficient loading and unloading of boats. So the shoes will go straight to Canada. And this is something that's sometimes referred to as drop shipping. That the entity who's actually sold the product will end up having the factory that made it just ship it straight to the client without ever taking it and putting it into inventory into a warehouse anymore. They own it. It's in title. It could actually legally be in their inventory at some point, but that's the actual physical product will just go straight to Canada. And then Canada is going to take the shoes and ship them out to all the Olympia Sports or other places that sell the shoes throughout Canada to athletes who want to buy Nike shoes. So that's our sort of product flow and our transactions. We've already asserted that it's very likely Nike, the Chinese manufacturer, is operating in a very competitive market, and probably this is happening for the Canadian distributor. And this is our fundamental issue, is that we need to, when we go in and start talking to a client about their transfer pricing, is we're going to end up having to ask them, how does the company's supply chain work? And parse it apart to determine which companies are doing which functions, which ones bear what type of risks. Very importantly, who owns the intangibles, the term used in transfer pricing, which would be the equivalent of saying who owns the intellectual property and who's developed it, who's spent the money building it up. That's the entity that should earn the return for those intangibles. So going along with our example then, Nike owns the intellectual property in this example. That is a barrier to entry. You can't just go out and start up a company instantaneously that looks like Nike, right? To start off with, they've got technology patents, right? They develop their air cushioned shoes, and that's different than the other manufacturers, and that gives them something there. But they've also got huge marketing intangibles. They've spent a lot of money on advertising, building their brand, signing up some of the top athletes to endorse their product. All those things come together to make the Nike product very recognizable and very desirable to consumers. So we need to solve two problems for Nike. One is we need the price, the transfer price, because this is an intercompany transaction for the Nike to buy the shoes from the Chinese subsidiary. And we're going to need a different transfer price for the price for Nike to sell the shoes to the Canadian subsidiary. Now your first reaction might be to say, well, why is there a different price? Well, because the Nike shoes the Chinese manufacturers is selling to Nike, Chinese manufacturer doesn't own any of the intellectual property. They can't put the swoosh on there without Nike's permission, right? So they're just manufacturing the shoe. Nike adds to it essentially the value of the brand. Nike owns the technology. They will sell the design rights to the Chinese manufacturer. They will say, here, you can go do this because you're going to sell the product to us. We will give you the design, and the design has the technology embedded in it. Produce the shoe exactly to our specifications and sell it to us. But we're not paying you as if you own that design. We own that design, and we own the swoosh, and we own all the other marketing intangibles. And then they're going to turn around, so they're not going to pay very much for that shoe, right? They're just getting a shoe. Then they're going to turn around and sell it to the Canadian distributor. They're going to say, yeah, we know you're going to go sell this shoe for a bunch of money because people are paying a real premium, but you didn't do really anything to generate that kind of profit margin. You're just out there, taking title to this material product, putting it into a warehouse, shipping it out to places. You're just a perfectly competitive distributor operating up in Canada. To the extent there's money to be made from the Nike swoosh and the marketing intangibles, etc., that's Nike's back in the US. Thank you very much. So we've got to come up with two different prices to deal with this. And here's how this is all going to sort of work out. So we're going to need to find comparable firms to the Chinese manufacturer. So very likely we go into databases that have got lots and lots of Chinese firms in them, and we're going to sort them and find the manufacturing firms, and we'll run lots of process to say identify the ones that are most comparable. Maybe they're also manufacturing clothing goods and shoes and other things that would be in that genre of industry. Maybe they're using the same amount of assets, if not identical type assets, to try to take this on. Maybe they bear the same risks, etc. So we want to find comparable manufacturers there. Once we find them, we'll determine their profitability. It'll be a range, right? They won't all make the exact same profitability, but hopefully it won't be too wide of a range. And we're going to set a price for the Nike purchase of those shoes from the Chinese manufacturer that will give it the same profit. When I say the same profit is actually measured in a currency, dollars or pounds or whatever. We're going to use measures of profitability we'll be getting into soon. Things like they'll earn the same operating margin, or they'll earn the same return on their assets. And these are ways in which we will determine that how to set the transfer price. We'll set the price so that they do hit that kind of profit that is expected of a Chinese manufacturer. So with that done, now we're going to have to move along. So let's set that aside and say now on the other side of this transaction, right, we're going to have to sell the shoes on. So let's suppose that we've got this Nike in China. Let's suppose it has costs of about $40 per pair of shoes, and it's going to sell the shoe to Nike for about $44. Ballparking it. All right, they're going to be earning about a 10% premium above their cost, 10% profit above their costs. For a manufacturer, that's probably kind of a realistic number. But it gives us, like in our simple fictional example here, some numbers that make it easier to sort of follow along what would be going on. Now, given that that's set there, now let's move on to what would happen on the distributor side. We're going to be doing the exact kind of same thing. We're going to be looking for comparable distributors first. We're going to find those comparable distributors, and again, we're going to search databases for firms, preferably operating in Canada. Maybe we'd even say, the North American market's fine, it's similar dynamics. We're going to look for them to say they've got the same kind of, say, assets, which are basically inventory mostly, and then some other maybe accounts receivable, etc. Then that they take the same kind of risks. They're selling the same kind of product. Maybe it's clothing, maybe it's shoes, etc. So we'll find those comparable firms and we'll determine how profitable are they. And then we will set a price for the Nike sale of the shoes to the Canadian distributor so that it will earn the same kind of profit as those comparable distributors, right? So what Nike sells to them will show up in their COGS. That'll affect their profitability. We will adjust that profitability, that COGS, what we charge for the shoe, so that they hit a targeted level of profitability. Now, what is that likely to end up being? Move that over to the side. Well, frankly, let's suppose Nike Canada will sell the shoes for $100. So they sell the shoes to Olympia Sports for $100, and who knows, Olympia Sports may be able to mark them up to $150. But Olympia Sports, that's third party to us. That's not affecting us on the transfer pricing. But the wholesale price might be $100. Now, let's suppose they are going to earn a profit of about $3. You say, did I just make that up out of thin air? No, actually, I've built a number of sets over the years of what distributors earn, and a wholesale distributor probably earns an operating margin of about 3%. So if they sold the shoes on for $3, their operating margin likely to be about 3%. So in that case, it's going to probably have a P&L that'll say something like it'll pay $90 to Nike for the shoe, and it's going to have some SG&A, some selling and general administrative expense. Won't be super high because they aren't doing the big Nike ad campaigns. They're just doing their selling and general administration. Say that's about $7. So they pay $90. They've got their own costs of about $7, leaving them with about a $3 profit. Pretty realistic on that side. So where does this leave us then? Okay, we've got this product flow and the shoes go out and it's a perfectly competitive market in Canada and China, but Nike is where the value proposition is. So effectively, Nike would pay $44 for the shoes from the Chinese manufacturer and then sell them to Nike Canada for $97, and it's going to earn a gross profit of $53 on that. And from that, it's going to have to cover its SG&A, its sales and general administration expenses, etc., that's going to include their advertising budget, and that is significant for Nike. You can imagine. Let's suppose that that's going to be like a $25 expenditure in this chain, leaving Nike with a profit of 28. That's the profit of Nike as sort of a standalone entity. The group profit in total is going to be 35. It's going to be the 28 that you record in Nike. Then it's also going to be the $4 of profit earned in the Chinese manufacturer and the $3 of profit earned in the Canadian distributor. When you consolidate all of this, the group will have a profit of 35, which, ballparkish kind of numbers I wouldn't be at all surprised by. So, with that, after Nike pays an arm's length price for the shoes from the Chinese manufacturer and then sells the shoes to the Nike Canadian distributor at an arm's length price, it will retain all of that residual profit that's associated with the brands and the patents. And that's the very important feature of transfer pricing, which is we test the simpler entities, we give them profits that would be appropriate for the businesses that they are conducting, and the residual profitability ends up with the party who owns the intellectual property. So, quick summary, our example had 2 intercompany transactions. Each transaction we determined which of the 2 entities would be simpler, Nike or the manufacturer, Nike or the distributor. In these cases, we determined that the manufacturer and the distributor were probably the simpler entities. We would probably be better able to go out and find comparable firms for that than trying to find firms that are comparable to Nike. Then we set a price such that the relatively simpler party, right, earned as much profit as the comparable firms. All of the remaining profit would be earned by the entity that is the more complex and likely owns the intellectual property of the organization. Think about it. If something were to happen that severely damaged the Nike brand, that gain or loss, that damage, if it damages the brand, it's going to be, a loss or at least a reduction in profits, happens to the corporate entity at the top that owned the intellectual property. It shouldn't have any real impact on the 2 entities. If the brand is hurt and the company up in Canada can only sell the Nike shoes now for $80, then you're going to say, oh, well, we're selling them for $80. We probably still have the same $7 of SG&A. So I've got to earn that back, and I'm selling them for $80. I should probably have an operating profit of about $2.40, right? Which would be 3% of the 80. So I can work backwards to come up with, when I buy them, I'm going to have to buy them for less. So Canada is still making the same 3% operating margin, and the loss is going to be showing up in the Nike organization that had, say, the damage to the brand value. So that's essentially a whole presentation about picking the simpler of 2 entities. They're going to be our tested party, and then we're going to have to go out and find comparables. Our next lecture is all going to be about the process of trying to find comparable firms, and also picking what profit measure would you use to try to determine how much profit each one of those 2 entities should earn in their intercompany transactions. Thanks, and have a good day.